You're listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
Back, enjoy the show. What is up, everyone? This is Paul Apostolakis. We've got Brad Weisgerber. We've got Salvatore Cusmano. We are Inside Real Estate. Thank you for joining us for another episode of our show. I think we're at like 170 episodes now. And for those of you that are just finding us, thank you for finding us. We are located at Facebook.com/IRE Podcast. You can find us on irepodcast.com or anywhere that you listen to podcasts. We are available. Please like, share, subscribe, and please leave us a review. That always helps us out a lot. Guy, how you doing?
Good morning.
Morning, boys. Today we've got a really cool guest. He's from New York. He's a investor in multi-unit properties. His name is Sam Liebman. He's the founder and CEO of WealthWay Equity Group. Really nice dude, really looking to give back and kind of educate the community on how to get into multi-unit properties. He also is CEO of Rolling Cash Realty, a real estate management company, partner in a certified public accounting firm. He's got a new book. It's called Harvard Can't Teach What You Learn from the Streets, the Street Success Guide to Building Wealth Through Multifamily Real Estate. Really interesting guy. Let's get him on the show. Mr. Sam Liebman, how are you, sir?
Hey, happy to be here.
Welcome to the
Good
show.
Morning.
Thank you.
So, Sam, you've been in the business for 30 years now, doing multifamily units. You've got a lot of experience. Tell us how you got into doing real estate.
Well, originally I was just a kid from Canarsie, Brooklyn. Grew up poor, dysfunctional family, and I just fought. I majored in accounting, which is, to me, gives you the best foundation for any business. Just don't make it your profession, which I did. Very, very hard profession, but you can go to any other profession. Great foundation. And I represented through firms, a lot of developers. And then in 1982, I was able to get a job with a young, brilliant attorney in New Jersey named Bob Lieb, who was leaving law to start a development company called Mountain Development Corp. And he hired me, and it was myself, a secretary, and Bob Lieb, in a little office in West Orange, New Jersey. And 3 years later, he had over 20 million square feet of office space in 5 different states. So I got what I call my Harvard education. And a lot of that had to do with, again, learning, mastering the fundamentals, and exposure. He gave me tremendous exposure to things, which really cuts your learning curve and teaches you what goes on, under the table, in the back room, things you'll never learn in school. So that's how I got into real estate. And then upon that, when I left Bob after 3 years, I then went back to accounting with a college partner of mine, who's still my partner and friend, Neil Tepper. And we formed an accounting firm. We represented a lot of developers. And I saw them making fortunes, and I was their scorekeeper. I had to keep track of their money. I said, I could do this. So I then had a client that was a management company that represented owners in Manhattan of 4- and 5-story walk-up buildings. He had about 80 of them. And I hooked up with them. My background through Bob Lee was syndications. So I knew how to raise money, put people together, had structured deals. What I didn't know was management or construction. So I teamed up with Jim Kinsey from the Kinsey Corp, who was a client. Now he was a part. He knew management, and a third fellow, an older person that was able to. He had the money, so we were able to front the money and then syndicate him out. Now at that time in 1992, there was a ton of buildings, cheap buildings, no money, as opposed to today where there is a ton of money, but no properties to buy that make sense. So during 1992 to 1998, call it, we bought over 30 buildings at bargain basement prices. Best time to buy real estate is when nobody wants it. We did the same thing in 2008 when I was introduced to Austin, Texas, and we bought another 30 buildings during the .com bubble that burst, and we bought those very cheap. And we took those buildings, and I will tell you that some of those buildings, I'll give you one. We paid 2012. We bought these 130 units in Texas for $5 million, and today it's worth between 15 and 18 million. So by learning and mastering fundamentals and doing what we did, the book Harvard Can't Teach What You Learn from the Streets actually talks about how we bought these buildings so cheap, what we did to them to make them so valuable. And it wasn't just interest rates. There were many factors.
Yeah.
Did
yeah.
you
And now
offload
with
them,
interest
or
rates
are they rentals, or
I'll go ahead, Sal.
yeah, what'd you end up doing with most of those? You offload them, or do you still rent them out, or what's the?
Okay, good question. So we keep everything. Okay. Now we focus on increasing property value. We focus on building wealth. Now there's a difference between being rich and being wealthy. Chris Rock said it best. He said, Shaq is rich. The guy who signs his check is wealthy. And there's a difference understanding between rich and wealthy. So if you achieve wealth by owning a large asset base that increases annually and over time, when you flip houses, for example, which I'm not going to put down, but you buy a house, you do all this hard work. Let's say if you develop it, you build, you flip. Where's the large asset base that increases annually? It doesn't exist. You're paying taxes on the money. You have to go find another property to build. So if you find a great property and you renovate it, let's say, and you keep it, it's like an oil well that keeps pumping. You need money, you refinance. So we kept this and we built hundreds of millions of dollars of assets that are increasing over time. And everybody will think you need money, but the truth is you don't need money, you need knowledge. Right now, you have to identify knowledge. You have to be able to identify opportunities that are overlooked by others. And you do that by mastering the fundamentals and building upon. And that's why the book, Harvard Can't Teach, We Learn from the Streets, gives you that foundation to build upon. We introduce a lot of these concepts. We talk about how important the increasing property value is and how really easy it is to do once you know the fundamentals.
Yeah, it's I mean, to your point, right? Like, and I think this is in a lot of people's head right now, especially in residential market. Like, should I sell because I'm going to put $100,000 in my pocket, right? And they put down $5 or $10,000 when they bought the house, or should I rent it, right?
Mm-hmm.
Chances right now, like if you owned a home in the past 3 years, you probably have a record low interest rate, right? So if you don't need to sell, you probably shouldn't, right? Someone else is going to pay that asset off, and you'll probably cash flow from it in the meantime too.
Well, it depends on your philosophy, okay? If your philosophy is to be in real estate and it's your passion, then accumulate assets. If your passion is to be flip, I'm not knocking flipping. I'm just saying, understand the difference. You're not going to be wealthy flipping houses, unless you do it in a massive way. Or if you bought a 2-family house, I'll give you a great example. Let's say you acquired $10 million worth of real estate, which, trust me, is not hard. Sounds like a lot of money, but with agency financing now, low interest rates, non-recourse financing, you got to group together. If you have the knowledge and the fundamentals, you're able to buy 3 buildings. You accumulate $10 million worth of multifamily real estate. And let's say it increases just 3% a year, which is, nothing. There's so many things that you can do to add value or decrease operating expenses to increase value. So $10 million times 3% a year, just 3% a year is $300,000 a year. 5 years, that's $1.5 million in equity, gross equity that you've created. And that's not accounting the amortization. If you choose that to pay off the mortgage, it doesn't include the cash flow you get that is sheltered with depreciation. Now, let's say you buy a 2-family house for $750,000. Well, if that goes up 3% a year, that's only $22,500 a year times 3 years is, I think, $112,000. So we have $1.5 million versus $112,000. What's the difference? The large asset base that's increasing annually and over time. And what are you going to do to increase a two-family's house? Build a better porch? You're limited in what you can do. So really, when you buy these two-family houses or even small shopping centers, you're just buying a return on your money. But when you buy multifamily, there is so much opportunity. The industry calls it value add. Being able to increase rents, decrease operating expenses, etc., to increase property value massively. And that's what we focused on. And all I'm trying to do now at my age, I'm 66. I look maybe a little younger, but I am 66. I've done this. I built 21-story buildings. I've built a lot of stuff, done a lot of stuff. And I want to teach people how to step in my shoes, go back in the past, and follow what I did, learn the principles so you can do it too. So it's a matter of what you want to focus on. Do you want to focus on getting to the larger place of building massive wealth, or do you want to flip houses? Right now, if you flip houses, where are you going to find the next house? The next opportunity? It is just so difficult right now.
Unless you want to overpay for it, right?
But, yeah, well, you're going to overpay for everything right now.
Right.
So remember, you got to buy real estate when nobody wants it. Today, everybody wants it.
So I think, like from a perspective of, most of the people we talk to in real estate or investors who are looking at maybe small multifamily still, 4 units or less, right?
Mm-hmm.
You talk about increasing value, which obviously is like renovations and whatnot, right? But when you say decreasing operating expenses, what do you mean by that?
Okay. In the book and my philosophy, I identified 4 ways to increase property value. First one is to buy a property and do Zippo, nothing. Just hold the property, pray it goes up. A lot of people have done that and been rewarded because the market, anyone who held real estate for the last 10 years or more, it went up, right? But that's not what the pros do. What the pros do are the next 3, which is to increase revenue, right? Go into a property, put in better appliances, maybe charge for covered parking, put an investment of covered parking, charge for that. The third option is to increase the rentable square footage of the building. In other words, in New York, we would build into the basement, build duplexes. We would add onto the roof. A lot of properties, multifamily in Texas and other places, are underbuilt. So in other words, you can build I have properties I could build another 30 units on. So that's one way, increase the amount of rentable square footage. And the fourth way, and the easiest way, is to decrease operating expenses. Now, we're all familiar, I believe, with NOI, net operating income. So value of a building, you take your operating expenses, your revenue, minus your operating expenses equals net operating income. You apply a cap rate, so it's 5%, let's say, and you get an estimated property value. So if I see a building where water and sewer on 100 units, water and sewer is $80,000 a year, but I know it should be $60,000 a year, I know right away there's water leaks, undetected water leaks. So if I could identify and fix those water leaks, I can increase my NOI and property value, let's say $5,000, $10,000 a year. Well, a savings of expense of $5,000, $10,000 a year, if you divide that over a cap rate of 5%, that's $200,000 or more of increased property value. And that's the key that people have to realize. $1 of increased revenue or $1 of decreased operating expense can increase property value $20 or more just by understanding how the cap rate works. So whenever I'm giving raises or I'm looking for properties, or I'm always looking at how does this affect property value. We made an absolute fortune by buying C properties in A and B locations and converting them to B properties. And at that time, Fannie, Freddie Mac, agency debt were giving you 80% financing low interest rates, and even fix up money. This is back in 2012 to 2018. That doesn't exist anymore, but there is still agency debt that's available. We just refinanced a mortgage, okay, 130 unit building, okay. We got 2.5% interest only, fixed for 10 years with no reserves.
Wow.
Do you know what that does to your cash flow? And that's available out there now. There's so many creative ways of being able to do an interest-only mortgage. You can lock in low rates for long periods of time. And that's what we have done. I've refinanced almost all my mortgages to interest only. That's one way, through financing. But there are so many ways of reducing operating expenses. And that's how you build wealth. You see opportunities overlooked by others.
Yeah, I mean, there's a lot of ways to do it, right? And I think every investor probably has a somewhat of a different philosophy, but all the principles are the same, right? I mean, it seems like
absolutely. If
it's all about cap rate.
Yeah, if you do a 50-unit building or a 500-unit building, the principles are the same. The numbers are just larger.
Do you find getting started is harder today than it would have been 10 years ago?
It's harder now in the sense of being able to buy properties. It's easier in the sense that you have information at your fingertips that we didn't have in 1993 when I started. Also, a very important point. When I started, I was able to learn from a company to be able to learn management, construction, financing, working for one company. Today, everything is so specialized and becoming so corporate that if you work for a firm, you're going to put in management, but not construction. It's everything specialized. So you can't get that rounded education that I did.
Would you call it specialized or regulated by the government more?
No, specialized. Regulated is something else. Specialized means big companies, management companies, they have zoning departments, they have marketing departments, they have accounting departments, they have acquisition departments, financing departments. When I started, that wasn't like that. It wasn't as corporate. You had people who couldn't speak a word of English, foreigners that came here with no money, wound up owning the whole block of buildings. You can't do that anymore. Everybody knows what their building is worth now. The brokers have educated owners, telling them they have gold. So it's so important now to be able to look at a building. I look at buildings differently than most people. I look, where am I going to be in 5 years? You also have to look at the condition of the building, learn about that. Because if you buy a property, it has great curb appeal, but underneath the building, there's a toxic waste dump ready to erupt. So you have to do due diligence is tremendously important. Now, there's two types of due diligence. There's analytical due diligence, which is looking at all the leases, the expenses, the contracts. But I coined another phrase called psychological due diligence, which is chapter 5 in the book. And that means understanding and doing due diligence on the owner, the seller of the property. Why is the building for sale? There are good reasons and bad reasons. Who is the owner? What's his reputation? For example, if John Smith owns a building that's for sale, and I know that John Smith is a real pro that sucks every piece of potential out of that building before he sells, what am I going to do different than John Smith? Probably nothing. But if a person, a father who passed away, owned this building for 30 years, didn't really do anything to fix it up, it's now owned by 3 kids that don't talk to each other, that live in 3 different states, they won't put any money in, so they sell. Those are my kind of guys. Okay? Because I'm going to take that building and I'm going to increase that property value tremendously. So right now, there is a tremendous amount of money out there, overpaying, as we talked about, and very little product. So if there's very little product, you have to cherry pick by having the knowledge to identify opportunities overlooked by others. In fact, on my tax return, where it says occupation, you know what? I don't put real estate developer. I put opportunist.
Yeah.
On your 1040, it says that.
Yeah.
That's funny.
I love that.
Yeah.
I love that. So so now that you've done all this, you're just in a position in your life right now where you're just trying to give back and trying to educate people to kind of go down the same footsteps.
Yeah. Like I said, I'm 66 years old. I've given up trying to be the richest guy in the cemetery as I talk. And I love young people. I think a lot of them are lost. I have a son, 24. He was a film major, a great kid. He's in with me in real estate now. And unfortunately, it's hard because, you work now, you close an office and you can't really get him into the day-to-day. So I have him train more on an executive level. But again, the importance is there is no 4-year degree that I know of in real estate. And real estate is changing fast from a trade to a profession. Many, many times people have said to me, especially now, I want to get into real estate. I said, why don't you? And 9 out of 10 times the answer is, I wouldn't know where to start. And that's really why I wrote the book. Here's a place to start, to give you the fundamentals, tell you the story of how you make money, and then you have to add to that knowledge by doing your own research and so forth. Unfortunately, the marketplace, I call them motivational preacher teachers that just want your money. They're out there on that polluted marketplace, not mentioning names. I mean, it's just stupid advice. Go sit in a Mercedes for 15 minutes so you'll feel what it is to be rich. Well, I say go get a bench at bankruptcy court and know what it feels like to go bankrupt if you follow this silly advice. I mean, nobody teaches you how the car works. They teach you how to sell the car. I'm trying to teach you how the car works.
Yeah. Yeah. How much money does it take to get going, in your opinion? Like, do you have to have reserves in the bank to really get going?
You should always have reserves. If you don't have money to start, you have to learn how to put together a package to present to people who have money. And that's what I'm trying to say. If I had the algorithm right now for a Google and I had this locked up, you think I'd have problems getting money?
Right.
If I could tie up a building that had tremendous potential and I knew how to put it together in a package with some projections, I wouldn't have any problem raising money. So it's really not money right now. It's finding the deal. There's $300 billion of what they call dry powder on the sideline waiting to pounce in. I could tell you where I think there's going to be opportunities if you're interested.
Sure.
Yeah.
Well, I think that, and I'm writing about it, I think that office buildings and retail centers, especially office buildings, are going to be facing Armageddon soon. You don't have to work in a city to do business in a city. People don't want to take 2-hour drives or a dirty train to work, just like we are. Look where you are. 4 people. I don't know what state you're in, but we're
Michigan.
Yeah.
So, and I'm in New York. And Wednesdays and Fridays, we usually have a meeting, 5 people in 5 different states. So I don't believe that the occupancy in New York City right now is 30%. 30%. Wow. That's the occupancy. Wow. That's not, it might be 80, 85% leased, but people are not in the office. And I don't believe it'll ever go over 65%. Now, the ramifications of that are Armageddon. Because the valuation of that building is going to go boom. Banks, I think, are going to be inundated with massive foreclosures. And this is coming. Look, interest rates are down. It's artificial. We all know that. Being kept down for a reason, right? So, this is what's going on. Someone mentioned regulations. it is getting harder to manage properties now because you now have all these regulations, green buildings, and a lot of other things that were never enforced in it, but now are. You have HR departments, which we never had before. All this stuff costs money. So I think that when those buildings go, by the way, in 1993 and 2000, 80% of my buildings were bought in foreclosure. We bought what's called deed in lieu foreclosure. And residential, I think, is going to keep going up. It's the darling right now. You get tremendous financing. Try getting financing on office building that's 65% occupied. You're going to have personal guarantee. You got to put up 40, 50% cash. They're going to have reserves for interest, reserves for everything. You're going to have no cash flow. So if that office building that was 5, 10 million can be bought for 3 million, maybe it makes sense then. And if you think that won't happen, in 2010, we bought a 15 community, call it, 15 different properties within a mile of each other, portfolio. We paid $11,250,000. 5 years prior to that, it went into foreclosure. The other owner paid $56 million.
Wow.
Now I paid $12 million for that. I'm not trying to brag, but it's back up over $56 million. So when you buy a property, that's a permanent cost. You can't change with the value of the property that you pay. That's why everyone says you make it on the buy. So I think that there's going to be opportunities in the office and retail sector to buy these properties soon at bargain basement prices. That's where I see the opportunity. I think if you buy rental, you're going to get tremendous financing. You're going to overpay. Rents are going to keep going up. There's a shortage of rental housing right now for a lot of different reasons. And I think that's going to continue in the near future.
So, yeah, you're seeing the residential market being squeezed like everybody else.
Yeah, I mean, I'll give you an example. In Texas right now, if you have a really good property, there's a $100,000 entrance fee. I don't know if you heard about this. So they'll take, you got to pay $100,000 for the honor of being able to get the materials to do your due diligence. If you are awarded the building, it's credited. If you don't, cost of doing business. So all these hedge funds and other big companies are paying hundreds of thousands of dollars just to be able to bid.
Wow.
That's crazy.
But that's what's happening now. If you could buy a building and get 2.5% financing, you're able to pay a lot more for the property, right? And most people don't think about tomorrow. Well, I got a 5-year deal. What's going to happen in 5 years? Even if I increase the value of the building in 5 years, if the interest rate's 4%, let's say, you got a big catch up to do, because at 4%, it's not as attractive to pay the price you paid, right?
Yeah. Real estate is still, I think, a good investment, even at 4.5%.
I do too.
Would you agree with that?
We all got spoiled. Absolutely. If I got 5% years ago, I'd be thrilled. When I bought my first building, St. Mark's Place, in 1993, with a group of people, I didn't do this all myself at the time.
Right.
We paid $575,000 for a building that was in foreclosure that had sold for over $3 million. The interest rate was 9.75%. Now, the price I paid is a permanent cost. Can't change that I paid $575,000. But today, that building's worth $15 million, and the interest rate is 3%.
Because the finance down, right?
That's right. Because the interest rate is a temporary or variable cost that changes. Price I paid is not. So you have to, So you have to be more sophisticated than we were in the 90s, because in the early 90s, nobody knew what their building was worth before the brokers started, taking people's buildings to get listings and giving them projections of what their building was worth. A lot of it was BS, but owners started to believe they have gold. And there was a disconnect. There's a disconnect now into what people think their building is worth and what it actually is worth.
How do you talk to a seller and bridge that gap?
Well, unfortunately, you can't even talk to the seller anymore.
Right.
You know, I used to be able to talk to the seller, use my personality. Used to be able to sit down with him and structure a deal. You know, what are your concerns? A lot of times I was able to structure deals because he had a tax problem. I was able to talk to him. Now, when you meet somebody, you know, what is the seller worried about? Is this guy going to be able to close? Is he going to be difficult in negotiations? That's what a seller's thinking. When you go to a broker, which you almost have to do now, you don't get that personal touch. You don't even know if the broker is hoarding offers. So if a broker has an exclusive and gets me as a prospective buyer through his exclusive, he gets the full commission. If I come in through a co-broker, he has to split the commission. So if they're the same in the same range, who's he going to lean towards giving the building?
Right.
You have to understand human nature. That's another issue. Human nature. You know, management companies. No management company is making money just on their 3% management fee. Trust me.
Right.
Okay, and we found this out many, many times. So management can make you or break you. You have to have great management. You have to have people want to live at your property. Okay. I love properties that have bad management because I'm going to go in and give them good management. That's a big opportunity. So there's learning these fundamentals of how management can make or break you, how you have to learn that the way you build wealth is to own a large asset base. When you buy a house and you take a 30-year mortgage so you could affect the house, and you look at your amortization schedule, for the first 5 years, you're just paying interest. You're not paying really substantial amortization.
It's
you might even be better off renting, huh?
It's all interest, for 10 years.
So everybody thinks they're better off. You might be better off at that point renting, right? Especially if you're overpaying for the house. So people in my area, you know, good school systems, they're just bidding crazy. I mean, it is crazy. And unfortunately, young people now are getting priced out of the housing market. I mean, BlackRock, Blackstone, they're buying up houses and fixing them up and renting them out. I don't even know how they control this, how the scale works. I got a house here, house there, and they use GPS technology, but they're driving the housing prices up. Do you know in California, I think they're passing a law, or they just passed a law, that they're charging flippers a 25% penalty. Have you heard about that?
No.
Yep. 25% penalty for flipping a house because they say it's driving up the prices too much.
Flipping houses is bad now in California.
I'm not saying it's bad. No, I'm not saying I'm not condemning or saying flipping houses is bad. I just want people to understand the difference. You're not going to build substantial wealth that way. In California, they're putting in penalties now for flippers because they say this flipping is causing prices to be too high.
Wow, that's interesting. Going forward, now that you've done all this, what is next for Sam?
Good question. Well, right now I'm on the side. I'm basically watching the wheels go round and around. As John Lennon says, the world is upside down. Obviously, if a building comes along, my adrenaline starts working. That and I'll buy another building. I have to buy another building this year for tax reasons.
Yeah,
you know, real estate gives you the best legal tax shelter that I know. So what I'm looking to do basically is teach. My passion is now, you know, I thank God I have enough money. What I want to do, I was never about money, you know. So right now I'm trying to put together an online real estate academy called Street Success Real Estate Academy. I'm about half finished. And we're going to do something nobody else has done that I've seen. We're going to say, hey guys, I'm going to take a 150 unit building that I own. Here's every expense and every bill that was paid for the year. Here is every different type of income that we collected. Let's go through everything and master this. And once you master this, you're going to be able to understand any multifamily garden apartment complex, if it's 50 units or 500 units. So I'll give you an example. We're going to take a building that I said was worth 5 million, that's now worth between 15 and 18 million. And we're going to say, let's look at how it got there. Let's understand how to read a water bill or an electric bill. Let's talk about the contract. Let's talk about all the expenses that I was able to reduce, all the value add I was able to add, and let's learn from that. Let's build and learn from that with a real life example. And I think that's going to be a tremendous learning experience. One of my rules is if I do a podcast, a radio show, or a book or a course, my promise is for your viewers to be better off after we had the podcast to learn something than before. And I'm promising you're going to be rich by the time you wake up, or any of that other crap they say. But my promise is after reading the book, your knowledge of real estate will increase exponentially. That's what I want to do. I want to put young people and other people on the path to building lasting wealth. And also, I'm gearing my market to anybody that's working in a real estate related field. So if you're a broker, look, lawyers and accountants who are representing me, why don't they buy buildings? Fear. So if a lawyer and accountant, for instance, can learn to understand the other side, or a building manager, that's going to make them more effective in their job, because they're going to basically have a synergy. I know what the owner is looking for. I had a broker recently, okay? A young group of guys, I wanted to give them a chance. So I met in a Chinese restaurant with them, and they were supposed to give me a presentation of what they can do for some of the vacant space. So we're sitting at the table, and they're showing me pictures. You know what they did? They put together a beautiful package of pictures of my building. I said, guys, what are you going to do? What kind of tenants? Well, we'll take a look at what we did. And they're showing me aerial photos. They're showing me all this other crap. That is not what an owner wants to see. What an owner wants to see is, tell me how you're going to market this place. Tell me how you're going to get tenants. Tell me why I should use you. Why are you different? Now,
right.
if that broker had a knowledge of the other side of what owners are looking for in hiring a broker, I'm teaching that so they will be better equipped next time to say how we're going to market this place. So you're learning what the other side is doing. So that's another market.
That's awesome, Sam. That's awesome. Sam, we're getting close to the end of the show. So this is the part of the show where we do 3 random questions for you.
Uh-oh.
They're totally at random, and they have nothing to do with real estate a lot of times. So
Okay.
First question I'll ask you is, if you had to eat one food for the rest of your life, what would it be?
Cool boy. General Tso's chicken.
Yeah.
Nice.
All right.
Yeah, General Tso's chicken.
There you go. There you go.
I mean, who doesn't like General Tso's chicken?
Yeah, it's a pretty good thing.
Yeah.
I would have a long life though, but
Yeah.
No, it wouldn't last long, but it'd be good on the way out. Sal, you got another question?
If you could be a fly on the wall for any historic event in time,
wow.
right, what would that be?
The day somebody discovers that we're not alone in the universe.
Oh,
yeah.
future event.
There when
That would be cool.
that comes
Yeah.
true.
That'd be cool if it hasn't already, Sam.
Well, that's another. We could have a whole podcast on that, but
Right.
I think that will change everything. So I'd like to be a fly on the wall hearing that.
Yeah, I mean,
Yeah,
it's never really
that's
been like publicly said, like, yeah, this is an alien, right?
Well,
Like,
it's a long thing.
publicly-
It has to do with my hobby is quantum physics, and it has to do more with science and how we perceive our senses only pick up what we are able to see.
I agree with you, Sam. I agree.
Not how the world really is. I mean, you want to knock yourself out, put on a pair of infrared goggles and look at the sky. You won't believe what you see.
Yeah.
I'm not talking
Yeah.
about rocket ships or spacecraft. I'm talking about stars and lights and other things. So we it's like out of sight, out of mind. Years ago, I remember an asteroid was bombing Uranus, and people were more interested in Kardashian's new outfit than what's going on Uranus. So,
yeah. If you could listen to one song, if you could only bring one song with you on a deserted island, what song would that be?
Hey Jude.
Hey Jude.
I think it's one of the most beautiful songs. Paul McCartney, loved the Beatles, grew up with them, but Hey Jude reminds me of a happier time. Things were simple, as a kid. So every time I hear that, I pep up.
That's awesome, Sam. Sam, tell the audience how they can get a hold of you, man.
SamLiebman.com. And I welcome. We have articles. We have we're going to be doing crossword puzzles. We're in transition now. We made a mistake with the people that were doing our website, geared it to how great Sam Liebman is, and they were putting up what I did, what I that. No. The website has to be what can I do to help you. And so we're changing that whole paradox around. So it's going to be people can go on. We're trying to form a community where people can get together, learn together. We're going to be doing some clubhouses. I don't know if you know Clubhouse, the new technology.
Yeah.
So it's all right now about teaching, and I've never done this before. I mean, I'm not a public speaker. I tell people my only professional performance experience was in first grade. I was L for Liberty for the men who gave their lives. So this is what you see is what you get. I'm not a bullshit artist. I tell the truth, and I want people to learn the right way. The right way.
That's awesome,
and don't
Sam.
take shortcuts.
That's awesome, Sam. Sam, thanks for spending some time with us, man. It was much appreciated. You were really interesting to talk to. You're the best, and we'll follow up in the future.
Thank you very much. It's been an absolute pleasure. I love doing this.
Awesome,
Thanks,
Sam. Have a good one, man.
Thanks.
Bye.
Interesting dude.
Absolutely. I love the New York accent.
Yeah.
All the time. It's great.
Lots of
Yeah.
Yeah, I mean, we really do learn a lot though, like every week on something different way to look at things, I mean,
Yeah.
I never really thought of the expense part, right? Fixing leaky pipes and whatnot, upping your cap rate.
Yeah, we learn something with these guys every week, and it's interesting. Everybody's got a different perspective. Everybody's got a different perspective and a different way of making money in the real estate game, which is, there's so much money in the real estate game that there's just different ways to do it. So, all right, everyone. Thank you guys for listening in. For those of you that made it throughout the whole show, thank you. Find us on irepodcast.com. Please like, share, subscribe, and leave us a review. And always go to Facebook.com/IRE podcast. If you want to see us live, or go to YouTube, or just Google Inside Real Estate Podcast, and you'll find all our shows. Have a wonderful day, guys.
See ya.
See you next week.
You've been listening to Inside Real Estate, the nation's top real estate podcast. Don't forget to follow us at irepodcast.com and everywhere where podcasts are available.